Treasury yields with respect to the 10-year have popped quite a bit over the last couple weeks and look like they're heading up to the top of a massive base that yields are putting in. Hi, this is Mark Arbiter with S&P's Chart Room. Taking a look at a weekly chart of the 10-year Treasury yield, we've popped from about 160 all the way up to the 2.3% level. We broke above this declining trend line here and had a retest after we broke that trend line, and we've continued higher. As we've said all along, we believe that the market is putting in a massive inverse head and shoulders with the left shoulder here complete, the head complete, and we're currently working on the right shoulder of the pattern. As we've noted, this is a fairly large pattern going all the way back almost to the middle of 2011, and as we've said, we think that this pattern will take some time to complete. Now, all along, the key level here has been the top of this inverse head and shoulders up at the 240 level. We think yields could probably move up to that area over the next month or two, and then I think we're going to see some digestion within the market as the prices have gotten very oversold, yields very overbought. This 2.4% level here represents chart support on the yield chart. Yields are inverse of prices, so normally this would be a chart resistance point, but no, because yields are inverse to prices, this is actually chart support. So we think yields could climb up to that 240 range and then back off a bit as we digest these losses here and work off some very oversold conditions within the weekly chart with respect to prices. We've also seen a cross here. This happened early this year where the 13-week exponential moving average, which is the red line, crossed above the 34-week exponential moving average. That's the first time that's happened in quite a bit of time. And then we came back and retested, or the 13 came back and retested, slightly undercut that, and then took off again. That was certainly a bearish sign. As you can see, all during this tracing out of this inverse head and shoulders, the 13 remained below the 34-week exponential moving average. If we take a longer look at Treasury yields going back to 2007, the peak back in 2007 was up at 5%, a little above. We've drawn this trend line off the peaks from 2007 to 2011, so this represents trend line support. What could happen here, what many times you see with charts that are putting in big bases or big tops, becomes multiple levels of chart support or resistance at a certain area that creates a lid on prices or a lid on yields. So it's very possible that if we get up to 2.4, move sideways, this trend line could come into play and also act as support for yields as we trace out this very large inverse head and shoulders. We will say that once we break this 2.4% level, we will have completed this major reversal formation, and then based on the size of the formation, which is about 100 basis points, we could then see a move up to 3.4, 3.5%, but I don't think that's going to happen until later this year, probably next year. That would be also the next area of chart support. Next previous high was just above the 3.5 level going back to 2011. So in summation, I think we could run up to the 2.4% level for 10 years and then probably move sideways, digest these moves, work off some oversold conditions with respect to weekly momentum, and then eventually We see this inverse head and shoulders playing out with the breakout of 2.4 and heading above the 3% level sometime later this year or possibly next year. This has been Mark Arbiter with S&P's Chart Room.